very much for coming. We have a really amazing panel in front of us. Our company's recalibrating their risk appetite to invest in the super region. And what we have is a panel full of really incredible investors in the mining sector to discuss this. I'm going to let each of them introduce themselves and sort of what they do and how they invest in the sector. And then we'll start diving into what the risks in the sector are from their perspectives. So, starting with Chris?
I'm Christopher Eccleston. I'm a mining analyst and I'm based in London.
Yes, I'm Owen Hegarty. I'm Executive Chairman of EMR Capital. We are a private equity company investing in mining projects worldwide, and I'm based in Melbourne, Australia.
Hi, I'm George Cheveley. I work for 91 based in London. I run a global gold fund and a global natural resources fund, and we're also looking to establish an office here in Riyadh.
Hello, my name's William Husband. I'm global head of metals and mining at Citi from the lending perspective, based in London.
Mike Barton, I'm a managing partner of Orion. Orion is an investor in mining companies around the world. We focus on construction financing and acquisition financing.
Hi, my name is Roger de Larenbalje. I work for ES Advisors in New York, and we help mining companies to raise capital.
Great, thank you. So, investing in mining is really all about identifying risk and managing that risk. And as we try to massively increase the amount of metals in mining generally, but critical minerals especially that we're investing in going forward in order to enable the energy transition, the super region and other regions of the world that we have not traditionally invested in, like the super region, are becoming more and more important. So I would like you, from your own perspectives, to discuss what you think the risks are and how, in your capacity, you mitigate those risks. So what is the biggest risk from your perspective? Let's start with Chris, who manages as an analyst, especially for junior and development stage miners. From junior and development stage miners, where do you think they're seeing the risk come from?
Well, in my understanding of the super region, as it's been explained to me, it's somewhat sort of like oval-shaped structure that stretches from the stands in Central Asia through this Middle Eastern region and down into Central Africa. Is that correct?
Yeah.
So we have different levels, I think, of country risk, I think, is the main risk in this region. It's not geological, because obviously people have known for a long time that the stands have fantastic geology, fantastic resources. More recently, we've been seeing that people perceive the Arabian-Nubian Shield as also an area with enormous future potential. And then Central Africa has maybe for 100 years been exploited for specific minerals, not the whole gamut, but it's also been an area that has had a lot more political turmoil and military turmoil than the other areas. So I think it's got a lot to do with political, military risk in these areas, more than geological risk, because I think these areas have proven themselves to be enormously prospective and historically enormously productive.
Owen, you are in private equity, a prolific private equity investor. Maybe from a private equity perspective, you can talk about where you think what are the top risks of investing in this region?
Well, thank you, Amanda, and thank you for the opportunity to be here today and have a bit of a go at the panel. And a very, very interesting topic in terms of risks in the super region here. Very interesting and very topical, particularly in respect, Amanda, of the energy transition and the requirement that we've heard a lot about today, actually, the increased requirement for critical minerals, some of the existing minerals and materials and commodities and so on, but there's been a bit of a boost in all of those, but there's also a boost for some of the critical. Okay, and they're going to have to come from, supply side, and we're mostly supply side people here, so we're going to have to do our work even better in this particular region. As far as the risks are concerned, Amanda, we're in mining, we're in processing and so on. All of the usual risks are available to us, whether they be geopolitical or geotechnical. They're all available to us at this time. And we do have to go through the process of evaluating them, recalibrating. People are recalibrating those risks all the time. As a private equity investor, as a strategic investor, as a corporate investor, as a portfolio investor, you're always looking at these things. The way we tend to look at it, well, all of those things we're looking at them all the time, all those particular risks, but we're also looking at the opportunity. So we see it from the opportunity side first, the positive side. Where can we invest for those minerals? Where are the ore bodies? Where's the potential? Where should we be going to actually supply for the world these future minerals and so on, and then evaluate the risks of that particular project.
Very, very good. George, you're on a slightly different side of it. You deal with a lot of the larger sort of public companies as well. Where are you seeing from the public markets perspective, from investing in the public markets perspective, where's the risk biggest for you?
So, I mean, the reason we run a fund is to offer investors a spread of risk and diversification. So they're not just putting all their eggs in one basket. And obviously we do that geographically, by mineral, by management team. So we're looking for a whole spread of companies who will offer those returns, and not too much in any single one. We can't by regulation. But when we're looking at companies and seeing what risks they're taking, we're looking at very similar things. Have they got just projects in one country or several countries? How is their governance? What are they doing? What's their social program like? We are looking at all of these elements when we look at the companies we invest in to try and minimize the risks we're taking. And certainly when we look at this region, we have investments, or certainly companies who have assets in this region, but not a huge number because there aren't so many assets. So in one sense, I look at this region as a great diversification for us, because it's not somewhere we have a lot of exposure, and therefore it's somewhere we can increase that exposure as long as we find the right companies with obviously the right assets, but the right governance frameworks, etc., around them to mitigate those risks as much as possible. And then, of course, we will look at new regions, we'll look at more difficult countries, and we say, well, we think the risks will be mitigated, but we will need a higher return to still justify. So that's what we do. But in some ways, people say, well, that's a new region, that's risky. On one side, we look at it and say, well, that's good for us because it's diversification.
Excellent. William, lending. You guys write the big checks, which means you take the big risks. Where are you guys seeing the risk on the lending side?
In terms of the super region, so-called, I'm not sure there are more elevated risks here versus any other so-called mining jurisdiction. In fact, if you think about some jurisdictions, there could be less arguable risks here. So nothing raises its head. So I'll answer your question by saying that the new area of risk that traditional bank lenders, private equity, public equity, and every form of capital provider that sits in between those two bookends increasingly have to pay attention and scrutinize ESG. That's what's relatively new. Not that ESG or the E or the S or the G independently is elevated in this region, but a risk will be now, what's your carbon footprint, where you operate your mines or processes, what's your relationship with your local communities, what are you investing in there. But that's not specific regionally, that's just a new lens through which capital to mining is looked through.
Excellent. Mike, Orion is exposed to just about every part of the investing cycle when it comes to what I would say the execution risk on developing and building mines, which is potentially the riskiest part of the mining cycle in my view. How do you, when it comes to execution in the region, where are you guys looking at risk?
I mean, I think the first thing I'd say is risk across the super region is not homogeneous. It's a very varied region, so we really look at it on both a case-by-case basis and as an overall portfolio. So on a case-by-case basis, we do a risk assessment of every single project individually and look at all aspects of risk. We don't focus on geopolitical risk in isolation. We're looking at geopolitical risk, we're looking at social risk, we're looking at governance risk, we're looking at environmental risk, execution risk, project quality, and we have all of this in a fairly dynamic risk model. And so we're assessing these individually. The way we look at an individual project is that will then spit out effectively a risk score, and that will determine the return that we expect to make on that particular project. We're then aggregating that into a broader portfolio and trying to understand how that fits in with the overall exposure we have, both in its aggregate, in that we don't want lots and lots of overall investments that are particularly risky. We want a blend of risk. And then individually across those kind of types of risk. So we don't want a concentration of expropriation risk. For example, we can maybe take one piece of expropriation risk and mitigate that as well as possible. But even across the super region, there's a huge variety of risks in those countries involved. And I think what we focus on more than actually once we've assessed the risk is how one mitigates the risk. Because I think that's actually the more important thing. There's always risk out there. There wouldn't be returns were there not risk without being fairly obvious. So what we're trying to do is we're trying to identify those risks very specifically so we can put in place mitigants for those risks as best as possible. If you ask me a slightly different question, which is what's the risk that it's perhaps most difficult to mitigate across all those that I've mentioned, probably the social risk. Social risk is very, very subjective, firstly, and it's very, very challenging to mitigate social risk other than through good execution. Whereas many, many of the other risks that we encounter, we can actually put in place either structurally or through controls, good mitigants for those risks.
Yes. Going into social risk and sort of other parts of it, Roger represents a lot of companies, especially from North America, that are investing globally in the mining sector and now slowly investing in the super region. I think from your perspective, what do you see investors seeing as the perceived risk in this particular region? Because it is a new region for investment in the mining sector. And what is the perception out there, in your opinion, from your investors' perspective into this region?
I think from an investor perspective, and a lot of the investors in the mining sector coming from either Canada, the United States, or Australia, initially the risk is the risk which they don't know. They're just not very familiar with the region and what type of risk there are here. So initially they need to get familiar with the local dynamics which you see in this region. But I think some of the risks they have identified is that the change which countries make when they develop their mining sector. Certain countries in Africa have required local processing in these type of countries, which can be a game changer, because a lot of these countries are convinced that they are very good in local production, but developing processing in each country is quite a risky business. And I think the second element they have identified is, even if the opportunity is great, how do I get out? There are not that many of these fairly large, diversified type of mining companies just yet here established with enough liquidity on the stock market to exit at the right time when value has been created.
So, risk being the biggest subject for all of us, I think we all are largely agreeing that there are no specific risks to mining in the super region that are specific to this area, and frankly every mine has its own risks that need to be identified and mitigated before any of us in our capacities will ever invest. On a more general sort of look at it, we all invest not just in the super region but also globally. From your perspective, what is the one risk to the mining sector that you think is there that isn't being really considered adequately in the mining? In general, what risk is out there for mining generally all over the world right now that you don't think is getting enough attention? Maybe we'll go the other way. So, Roger, I'll put the spotlight back on you to answer first.
Yeah, from my perspective, I think it's the lack of capital. We go to many of these conferences, PDAC, Indaba, and the elephant in the room is there is not enough capital. From a private side, you see a few gentlemen here which have been successfully raised capital to invest privately, but that's only maybe a two handful type of very large type of investors. The public markets, they don't necessarily invest in mining, not because it's risky, because the mining companies are too small. So they start only investing in these companies when they reach market caps of $500 million. So the whole junior mining space is screaming for funds, which is not there. In Australia, it's still, the retail market is still relatively strong, but in Canada, for instance, the retail market has other type of high risk, high reward opportunities, and they pivoted to these type of sectors. So I think a lack of capital really enables a lot of junior mining companies with the right type of deposits to kickstart exploration or getting through the feasibility studies to get to construction.
Excellent. Mike?
Yeah, I was going to actually say exactly the same as well. in that the sort of the risk that no one really talks about, particularly when we think about energy transition, is we require such investment in mines and infrastructure, but in mines in particular, to provide these new sources of metal. But the biggest impediment to that is going to be the available capital. And at the moment, we don't have the right level of incentive prices to get people, particularly generalists, into the equity markets in particular, to run back in. So it's a real problem. Oddly, in this, when we focus back on the super region, we've got a slightly different problem in that we're in the one area here in Saudi at least, and maybe the Middle East in general, where actually there is available capital. But if you talk about the super region more broadly, and we're including East Africa and we're going into Central Asia, to Rogier's point, you can't fund in this market. It's very, very challenging to fund East African projects or to fund Central Asian projects. Here is the one place perhaps in the world, plus Australia, where there is availability of funding in theory. Here we have a lack, as of today, of executable projects. But that will change. That's clearly going to come in due course as Saudi in particular, continues that domestic investment into the sector. But aside from Saudi, there's just a lack of capital.
Yeah, I remember reading Tesla's Plan 3, and I think they estimated we need by the end of the decade, we need 500 billion in new projects, invested in new projects, and 800 billion in the processing of the minerals from those projects just by the end of the decade, not to mention by 2050. So I don't know where that's coming from.
I was saying to somebody earlier that our pipeline has currently got $6 billion worth of deals in. We're going to be fundraising forever to find $6 billion of capital to fund those projects. It traditionally has run at about $3 billion. It's now up to $6 billion of executable projects. How do you deal with that? There's just a backlog of half-decent projects that need to be funded.
Yeah. How are you seeing it?
So just some additional data points. That is the biggest risk, the one that's already been discussed, as far as I see it. But it's not just the capital that no one can see, because mining companies' balance sheets can't fund billions into trillions of incremental capital, because that will end in over-leverage. We know what that looks like, and we don't want to repeat that. So if you then add on the 2 trillion of steel decarbonisation capital required, the 1 trillion of aluminium decarbonisation, then you're at levels where it's just silly to try and riff upon. The deficit, because it can't come from the balance sheets of the companies, has to be filled by wider stakeholders, the customers of the mining companies, whether that's construction, whether that's autos, whether that's consumer goods, and governments. And even that won't bridge the trillions of dollars. And the way you pose the question is interesting. So none of that's really priced in to publicly listed. George will argue with me on that. But none of that's really priced in currently. And just to raise another point differently from what the rest of the panel is going to agree upon on the risks, resource nationalism, it was kind of a thing 3 or 4 years back, particularly around Africa and South America. I think even Australia had a go. And then it kind of died down a bit. That's roared back onto the agenda of everyone, given we don't need to name names, what's going on in that geography between North and South America. So it's suddenly, okay, that's happened there. It's really happened. It confounded everyone. Is there copycat going on? And if there is, how the hell would you start to mitigate that?
I can concur. Capital has got a lot of customers right now, and I'm not sure where resource nationalism is concerned that anyone, like, in a place where there's a real fight for capital, I think anywhere with risk of resource nationalism is going to be finding it very, very difficult to get the investment required to develop their industries. George, public markets, they aren't valued anywhere near.
Look, I think the question is, why is that capital so reluctant? And I think actually, if you look behind, and we see it in public markets, is we're priced daily, our funds. People are looking at, shorter term returns, and it's always been the case for the last 20 years I've been running funds. We're talking to people looking at quarterly annual returns, and we're investing in companies looking at projects 5, 10, 20 years or more. I think that's getting worse. And why? It's because now we're in a growth area, an exciting area, and what we're seeing is a lot of technology coming in. And in some ways that makes it worse, because people are saying, well, it's going to take you 5, 10 years to really build this mine. And I'm not sure whether that material is going to be required or what amount will be required in 5 years, because I read articles every other day about people changing materials and whatever. So I'm not really quite sure, do you really know that that's going to be required? And that's a major problem, because we're going to require something, but just people aren't quite sure how much and what. The truth is we probably will need it all. But that's why I see the problem at the moment. People are just like, this is really exciting, but there's so much happening and so much changing. How can you commit capital for 10 years when I don't know what's going to happen in the next 10 years, because it's all speeding up? And so maybe you have to say, as a miner, you have to work out ways of speeding that up, doing smaller, faster, rather than the massive mega project open pit.
The
And
time.
you have to shorten the development time and the returns, because otherwise investors just cannot cope with that.
Yeah, I mean, the timing to build a mine, I think, has doubled from what it was 10 or 15 years ago. You are invested in many of these mines whose timing is blown out. Where, in terms of identifying that risk on the private equity scale, what's keeping you up at night, Owen?
Look, I think it's fair to say that the opportunity set is vast out there in this super region. No worries about that. I think we're all buying into that, going out over the next multiple decades, actually. We've got that coming at us. Humps and bumps along the way. We've always had them, and we always will have them. The opportunity is terrific. So what keeps you up at night? What do you really, really need? What must you have? You must have access to people, you must have access to capital, you must have access to land. Access to capital, plenty of capital up here, plenty of capital available. There's always capital available for the good projects. In terms of access to land, more and more people, and particularly in this region, actually understand that the world does need more materials to satisfy the demand, and generally speaking, people, countries, bureaucrats, politicians and stakeholders generally understand that they've got to be able to supply it, and the benefits that actually flow from the mining and resources and the mineral industry. They understand that because they need the jobs for themselves, for their children and their grandchildren. So they get that. So you will actually we believe that in all of these places you will be able to get access to land, provided, of course, you've got the right governance and sustainability and ESG regimes. You'll be able to do that. In terms of the access to people and the skills and labour, this is definitely keeping us up at night. You know, we're operating in Australia, very, very competitive out there. So therefore, you have to actually ensure that not only do you retain and train and sustain your people, but you've got to build that particular class. I mean, it's one thing to have the drone technology and automation and robotics and digitization and miniaturization and all of these things. You're taking people out of the equation, but on the other side of the equation, you need more and more people for all of the things that we're looking to do. So that's what keeps us awake at night, if you like. We've got multiple programs going, not only internally, but of course with governments and the regulator and various other institutions to be able to train up, more and more people to be able to deploy.
All right, I'm getting the signal that we need to move quite quickly. So last one, and fairly quick, if you don't mind, Chris. I'm sorry. What do you think juniors are seeing as the major risk?
I think expropriation is a risk. When come back to the super region, we have at the northern end the stands. Now the stands were hot in the 90s, as were the ex-CIS states, as they were called, and a number of expropriations, blocking of movements forward, strange sort of like autocratic governments that were of a different variety to what miners had been used to dealing with before, essentially took from around the early part of this century the stands off the agenda, and they've only just now started to have people really nibbling at them more than anything else. No one is really prepared to enormously dive in there, and only really one major Western company has profited out of the stands in all that period. Then at the other end of the super region, we have Central Africa, where we have the DRC, and the DRC now seems to be receptive again to Western miners coming in, but as we've seen, some of these projects have been developed by very big Western miners, and then they've had them taken away from them, or found themselves blocked, or had some sort of gun against their head that is forced to sale of the assets, and that type of thing has happened. It may happen again, and that is a major concern, that if you put in that much money, that eventually if you're taken out and the international arbitration process does not give you back the tens or hundreds of millions that you put into the project, you're standing looking at a loss and a major embarrassment and potentially an end of the corporate career.
Yeah, resource nationalism, I think, probably keeps us all up at night. I'm afraid that I'm going to have to cut us short because we're a little bit over time. I'd like to thank the panel for their incredible insights into the risk, both in the super region and more generally going forward from an investment perspective. And thank you all for coming.